Thank you very much for having us. This is joint work with Ron Duchin, who is at Boston College, and I'm at Arizona State. The title of this paper is The Efficacy of Remote Work for CEOs. And we're talking about top executives and their remote arrangements. Here I'd like to start by showing that CEOs have figured out that they could work remotely long before the pandemic and long before it became mainstream for the rank and file employees. You can see here a strong upward trend in CEOs working remotely or living at least within, outside of the reasonable commutable range, so outside of a 100-mile radius from the firm. And of course, this was catalyzed by the global pandemic. So what happened during the global pandemic, there was a wide adoption of remote work across all layers of hierarchy. But what's interesting is that there's a greater adoption of remote work for white-collar employees, especially with graduate degrees, management, and executives, and sort of high human capital workers. And then we had to, sort of a new equilibrium where the most common type of remote work was hybrid work, three days in the office, or 3 days working from home, and 3 days in the office and 2 days working from home. Okay, so when the CEOs were pushing the executives back to the office, Mark gave us a few really interesting anecdotes where the CEOs themselves remained to be remote. So what we're going to ask here is, how effective is remote work during normal business times? So two things that are different about this paper relative to a lot of other literature is, first, it's going to focus on top executives and their remote arrangements. And I think that's interesting because they themselves determine the remote policy for the rest of the firm, and they have a lot of impact on the firm's operations. And secondly, we're going to be operating outside of the pandemic, so avoid the confounding factors associated with the pandemic. And there could be at least a couple of different views on the subject matter. So first, you could think that remote work could lead to substantial efficiency gains, because a lot of what CEOs do, about 75% of what they do, is spend time in meetings. We could do meetings more efficiently on Zoom, and oftentimes we've adopted that practice post the pandemic because it's easier and oftentimes more convenient. And the next, 11% of their communication is just writing letters, emails, other correspondence that could be done, again, effectively online and from any location. So there's an argument that there could be efficiency gains. And certainly there are CEOs who are very strong proponents of this argument. So here I'm going to show you the CEO of Patagonia, who says, I'm a strong proponent of an MBA management style, where MBA stands for managing by absence. So on a typical day, you could see him wearing a suit and interacting closely with his board. There could be, of course, the agency view. It could lead to shirking. It could lead to leisure consumption, short-termism. And here I'm going to bring one recent example where the CEO of Twitter came out and said, I'm going to work remotely from Africa and manage my firm from 12 time zones away. And that led to a relatively swift response of the investors. The investors said, wait, one of the activist investors, Paul Singer of Elliott Asset Management, even started a campaign specifically to prevent the CEO of Twitter going remote, and generally said, we're going to make you leave if you proceed with that. The response of the stock price, you could see right here, was very positive. Investors said, well, even the possibility of preventing Dorsey from working remotely was associated with an 8% pop in the stock price, right? And that was an effective campaign because, a week later, the CEO came out and said, that was a mistake, you misunderstood me, and he canceled his plans to move to Africa. Okay. Then we had an interesting example where the principal agent conflict was removed completely in Twitter, because Elon Musk took Twitter and became the shareholder and the CEO. So there's no principal agent conflict. He said here on this picture, he says the next board meeting is going to be lit. And it was. So he comes on Twitter, and his first email to the Twitter staff is that all remote arrangements were discontinued. Executives are required to be back in the office 40 hours a week. And his kind of famous quote is that those who believe that coming to the office is outdated should pretend to work somewhere else. Okay. So this is the motivation for our paper, kind of to understand better what are these remote arrangements for CEOs. A lot of the paper is even describing them and educating how CEOs work in these remote arrangements and what might be the consequences for the shareholders and the company. A surprising outcome for us from this paper was that it's a very common thing even before the pandemic. So 18% of the publicly traded companies have had a remote CEO over the last 2 decades preceding the pandemic. And by remote, we mean somebody who's living more than 100 miles away of a round-trip commute from the company's headquarters. And they're truly remote. The average distance from where the CEO lives to where the company is headquartered is nearly 1,000 miles. They're present in every state, almost every state, or almost every industry, so they're very common, even before we went to the proliferation of remote work. Secondly, when we look at the efficiency versus agency hypothesis, well, probably both have truth to them, but what appears to dominate in our case is that we look at the same firm, we look at the same CEO, we trace their performance, and then we look at the switch where the CEO decides to switch going remote, and we see that once the CEO switches remote, the company's ROE declines, the company's market value declines, and the employees start complaining about the CEO and have lower approval ratings. And I'll show you what they complain about. Okay. Then performance gap expands with distance to headquarters and also with time differences. So for 1,000 miles, your performance deteriorates more if you're commuting from New York to, let's say, Iowa than if you're commuting from San Francisco to Seattle in the same time zone. Long distance CEO arrangements tend to be shorter, so oftentimes they don't last for as long as the typical CEO tenure. They're more likely to be terminated, and when they are, firm value seems to go up. Okay, so what are the economic channels? These are sourced directly from over 1 million of employee reviews of the CEO, and employees kind of highlight 3 main channels why they believe this may not be optimal. Short-termism, they see that the CEOs are kind of short-minded, and we find evidence consistent with that in lower R&D and in tilted investments with shorter useful life. CEOs, they argue that CEOs can consume more leisure, and we do find that they're more likely to purchase boats and beach homes when they work remotely, and the presence of those consumption items is negatively correlated with firm value. And then lastly, information frictions. A lot of employees say that the CEOs are a little bit out of touch if they're managing remotely, and we find investment becoming less sensitive to opportunities. So this is largely the paper. Kind of the takeaway from the paper is that remote arrangements appear to shift the CEO's incentives and productivity. Okay, so now that's the paper in one slide. Now let's jump a little bit into the meat to try to understand how we identify these arrangements, because they are quite challenging to identify. So first, we go into the CEO contracts. So CEO contracts are filed as exhibits to typically to the annual reports, and in those contracts, CEOs usually negotiate a clause that allows them to work remotely. So here's an example. Executives shall not be required to relocate his principal residence from LA to Englewood, Colorado. In connection with the executive's commute from New York to the company will reimburse him for weekly commutes from New York to San Diego. So step 1, it's in the contract. Step 2, it's actually being executed, because in the proxy statements, companies will have to disclose information on the CEO's reimbursements as other compensation. So here we're looking to see that the CEO is indeed being reimbursed for these commutes. So here's an example. Because the CEO is located in California and the company's headquarters are in Virginia, we provided him with a corporate leased apartment, and we reimburse him from travels to our headquarters in Minneapolis from San Diego. Okay. And third, we identify where the CEO's primary residence is located. So oftentimes the companies themselves will mention, well, the CEO's primary residence is in San Diego, usually like La Jolla or something nice coastal places, but sometimes they're being ambiguous about it. And when they're being ambiguous, we go ahead and confirm it by going to voter records, because voter records require you to have a state ID and by the location of your spouse. Okay. And then finally, we want to, I think the cleanest identification is where we lock in the firm and we'll lock in the CEO, so we take care of the selection issue and we just shift the status from remote to local and remote or local to remote and see what happens to companies' performance. So to identify these cases, we go ahead and we look at the amendments to employment agreements, which again have to be filed, so that clause is being removed. And when the CEO relocates, usually there's a big payout for relocation expenditures for a couple $100,000, and those are disclosed in the proxy statement as other compensation. So we confirmed indeed that they relocated and they got compensation for these relocation expenses. Okay, so with all of that, some interesting facts about, first, which firms hire for CEOs and why might they be doing that. If we look at the firms that at the time of their CEO turnover. So the comparison group is firms that hire a remote CEO versus other firms that are doing the CEO search but opt for an on-site CEO. So here, first, we don't see much difference in fundamentals. So similar CapEx, leverage, R&D, very similar fundamentals at appointment. Secondly, we're not seeing much difference in trailing or forward-looking performance. So these are not the companies going off the cliff and they're desperate to try to hire anybody and then going for people with remote arrangements. So you could see they have pretty similar. Trailing ROA, stock returns, Tobin skew, and then also take a look at the forward-looking performance. So they have very similar expected one-year returns based on analyst stock prices, expected EPS growth, analyst recommendations, and perhaps most interestingly, the buy and sell imbalance of insiders. You could argue that all of these things are hard to capture. Executives have forward-looking information, so one of the tests that we do is we'll look at the insider trades of CEOs, directors, and other executives, and we see no difference. So they don't anticipate a decline in company's performance, at least based on their trades. Okay, but where's the difference coming from? The main difference, the main driver, is the quality of the CEO pool. So the companies that tend to hire executives that are remote are the ones that have a more shallow executive pool in their state and within their industry. So those that are located in Wichita, as Andra was given in the previous paper, where there's a shallower pool perhaps of executives, go and allow executives from California to manage remotely a company in Kansas. Okay. So do firms end up getting better talent? A short answer is yes. By increasing the reach of this executive search, they're able to they're on average able to get better CEO talent. How do we measure CEO talent? Well, you could look at their education background, professional background, and so on. So here we find that executives end up being from better quality schools, and they're more likely to have gone to Ivies, and they're kind of a good measure of how much better these executives are is that your on-site CEO went to school with 71st percentile of SAT, your long-distance CEO went to school with an 84th percentile, so if that's representative, you could think of a 10-12% improvement in SAT percentile score of the individual. Okay. And they're also coming from usually better networks because they're typically located in metropolitan areas, so they bring more CEO experience, they're more central in the networks, and they have, this is an interesting characteristic, they have a higher, if anything, higher employee approval rate in prior CEO positions. But we'll find once they become remote, their approval rate will drop quickly. So a quick summary is that long-distance arrangements attract higher pedigree CEOs that might otherwise be unwilling to relocate to the headquarters. Okay? And the next question is, so how are companies able to attract these higher CEOs? And our answer is that they're able to do so by going outside of their traditional pool, by going outside of the locale of the and sort of overcoming the local segmentation in the CEO market, and by also hiring outside of their internal CEO pool. So if you take a look at this slide, so you'll see that more of these CEOs are born out of state, they're more likely to be external hires, and they have fewer connections with the company in general, but also at the same time, even though they're more likely to be external and they're more likely to be out of state, our variable long-distance CO is not very strongly correlated. So it is the correlation coefficient is only about 0.2 or less than 0.25. It's just a very distinct governance arrangement from just being external or being out of state. Okay. Now, some descriptive evidence on what are these contracts and what choices do COs make. So first, about 2/3 of these contracts are remote for the entire duration of the CO. So remote for the full employment spell. And approximately another 1/3 switch back and forth from remote to local. And this is what we're going to use for identification, because that will allow us to keep the match between the company and the CO locked in, sort of take care of the selection issues, and look into the changes around the switches. And our results are also robust for each of the three groups, and it's they're economically comparable, somewhat bigger for those for the entire tenure and smaller for the switchers. Okay. So now where do the executives actually live, given that they could live almost anywhere if they choose to be remote? So the first pattern is that they like to live on the beach. So 15% of executives are literally the first house from the coastal line. These are just warm locations only. You see, they really like Southern and Northern California. They're loving Florida and some other coastal regions. Okay. Secondly, these executives move to warmer and nicer, sort of less volatile climates. So they're moving out of the sort of central heartland states into the coasts of California and sort of the mid-Atlantic and Florida. And third, and this is consistent with the point that Steve was making about the high income earners caring about their taxes, they gravitate towards states with lower taxations of capital income and actually capital gains, right? So regular income and capital gains, we'll look very carefully at those taxes. So since we're in California, take a look at the border with Nevada. Nevada has a 0 state income tax. California's top bracket is 13.3. You could see a clustering on the right side of the border with Nevada, and the same with the right side of border of this Washington State, where Washington State has a 0 state income tax and Oregon has a high state income tax. So now the main results on performance and valuation. So this is the regression where the dependent variable is operating performance and are measured as ROA, and the long distance CO is a dummy variable that switches on when the CO is in a remote arrangement, right? So lives more than 100 miles away from the headquarters. So we find that the COs of the firm's ROA declines by about 70 basis points when the CO starts working remotely. Importantly, I think the tightest estimates are the ones that control for firm times CO spell fixed effects and industry times year fixed effects. So then we're looking within not just the firm and the CO, but particular spell in case the CO comes back to the firm after having a previous spell with the company. Again, about 90 basis point decline in performance. We also look at the time series of ROA. I've shown you some of the statics that there's no significant differences in trail in performance. This is a little bit more rigorously. We're showing that there's no significant pre-trend in ROA, so these are not companies that are on a declining trajectory that hire these COs. And then once COs switch to remote arrangement, the decline in performance persists at least for the next few years. Again, within firm, within CO, and within the CO firm pair fixed effects. Okay. We see similar effects in valuation, so we find that valuation goes down by, as measured by Tobin's Q's, goes down about 3.6% of the mean, or 4.8% of the standard deviation within the same CO and then the same company. So interpretation, once the CO switches from on-site to remote, the valuation of the company measured by Tobin's Q declines by slightly more than 3%. In the cross-sectional evidence, the decline in performance is steeper when the arrangement is more onerous. There's a longer commute, greater time difference. When the CO is more important, the CO is the chairman of the board, and the decline is smaller. So what are the things that mitigate the working from home and make it more productive? When when the firm is more geographically dispersed. So you may have heard about the CEO of Starbucks now is going to be managing Starbucks while living out of Newport Beach, California. So in this case, if a firm is like Starbucks or Macy's, they're quite dispersed. And there's a field office near CEO's residence. And coincidentally, Starbucks has set up a remote office in Newport Beach just for the CEO to work on. So they're probably aware of at least some of these patterns. Okay. Now, robustness, are these remote arrangements adopted in anticipation of performance decline? Again, you could always make up a story that there's something that they know about the future. The way we try to get at this is to look at the opportunistic trades of insiders. So these are the buys and sells outside of their normal stock disposition schedule or options vesting schedule, so off-cycle or irregular opportunistic trades. We don't find any evidence of selling before the appointment of a long-distance CEO. If anything, the coefficients go the other way. And we don't see any differences in analyst recommendations. So at least those that are expected to predict performance don't appear to predict a performance decline. Of course, there's still a possibility of an omitted variable. We try to come up with an instrument. And as this has come up in the previous presentations, a key driver of relocation decisions is one partner and spouse. So we're looking at the characteristics of the CEO's partners, spouses, as an instrument for whether or not they can work remotely. So here the instrument is going to be equal to 1. It's called uprooting the spouse. If moving the CEOs from home to the headquarters would uproot the spouse from their home state. So that would disrupt their network, community, access to family. So if somebody has a spouse who's grew up in California, connected to California, or is employed in California, and you're required to manage a company in Kansas, we argue this makes it more likely that you would work out of California. And the exclusion restriction is that the kind of spouse and their geographic origin should be unrelated to firm fundamentals. So there's some economic intuition and quotes supporting this argument. Beginning this summer, I'll be splitting my time between Seattle and LA, where my wife grew up. This is the CEO of Zillow. And then Snowden has had Boston connections since his Harvard days. His wife is from there. So his wife is from there, and he's commuting from Boston to Penn. We find that it's a very strong predictor of the decision to work remotely. So about 40%, a CEO is 40% more likely to work remotely if moving to the headquarters would uproot the spouse. The exclusion restriction, again, the private costs are plausibly, we think, unrelated to the firm outcomes. Regression evidence from two-stage IV regressions. The first stage, uprooting, is a strong predictor of remote work. And then the second stage, you could see the coefficients are kind of comparable, a little bit bigger than the OLS regressions. And why are they a little bit bigger? Well, our argument is that on average, you attract better CEOs by moving remote. So on average, that effect is slightly attenuated by the fact that they're higher type CEOs on average. Okay. So finally, I'm going to conclude with the discussion of economic channels. This is where we go to 1.5 million reviews on Glassdoor, where employees, insiders, mid-level management, other top managers are asked to review the CEO, and specifically, do you approve or disapprove the CEO's policies, and provide some free text comments. So first, we find that a CEO switch to remote status is associated with a 6 percentage point decline in employee approvals. Importantly, if you look at the interaction terms, the decline is stronger for reviews by managers or executives, or those that are located by the headquarters. So those who see the CEO coming and going, or aware of how frequently the CEO is in the office. Even though normally a CEO gets better performance rating by managers and better performance ratings by those who are at the headquarters. But these are the ones who are penalizing them. So why are they penalizing the CEO? They think that leads to short-term focus. They're short-sighted, prioritizing short-term goals, lacks a long-term vision. They also complain about loss of information. The CEO is out of touch, disconnected, confused, detached from the workforce, or simply lost. And absenteeism and leisure. The CEO is not around most of the time, invisible, generally generally absent. It's disheartening to see the layoffs are pending and the executives are taking helicopters back and forth to the headquarters. So this is the paper. The remote working arrangements help overcome geographic segmentation in the CO market. They do allow firms to get access to highly qualified hires that may not have been there otherwise, but they come at a cost. And the cost is that a CO switch to a remote arrangement is generally associated with a decline in ROA, Tobin skew, and employee reviews. And overall, I believe it's one of the first papers that studies the efficacy of remote working arrangements for top executives. Thank you for your time.
So love the presentation. One thought on the mechanism. So it was very interesting that you found that the effect was mitigated if the firm was more geographically dispersed. And I was specifically thinking of the work that Boris Groisberg at HBS has done for many years, where he finds that for these star CEOs, they are only effective if they can bring at least part of their team, the prior team, to this new organization. So I was wondering if you could just specifically look at the work from home policy of the C-suite. So even beyond, just very restricted to the C-suite, and if the C-suite was dispersed, whether the effect is even further mitigated.
Yeah, so this is a question about, maybe the CEO has their ears and feet on the ground through their second in command, right? They bring the CFO on site and they're working remotely. And oftentimes we do find a similar effect that CEOs oftentimes bring CFOs from their hometown or somebody they worked with. We haven't looked closely into that just simply because the data process of collecting this for every executive.
If the C-suite is dispersed, then no one cares that the CEO is somewhere far.
Yeah, well, absolutely. I think it's a very good point, Raj. Yeah, Steve.
So I can think of at least two reasons why CEOs might work remotely. One, it's a preference matter. You spoke to that quite clearly. Second, there really are benefits to the CEO and perhaps the organization of being located in your residence in a CEO-dense area. Okay, so if you think part of what the CEO does is network with suppliers, customers, board members, and so on, it's pretty hard to do that if you're stuck in North Dakota. It's a lot easier if you're in Santa Barbara and you have a home in Jackson. It looks like you have enough data to assess that. So in the cases where where the remote location of the CEOs appears to have negative effects, is that primarily because of the ones who are distantly located for what appear to be preference reasons? They grew up in Colorado and they want to live in Colorado, versus those who were already in these dense CEO networks. And there's a related point here, and here I'm going to poke at the urban economist again, take another whack at their traditional conception of agglomeration benefits. You got to think about what the source and character of those benefits are. One potential, I don't know whether this is important in practice, but one potential consequence of the rise in remote work is an increase in agglomeration benefits that come from people who are doing similar activities located in the same place, even though they are not located in the same place as, say, their employees. So there's multiple reasons why CEOs like to spend time in Jackson, Wyoming. It's a really nice, pretty area. But also, they go to the restaurant and they bump into other people like them, more so than they would if they were located almost anywhere else in the country. So you might want to put CEOs in one location, you put AI programmers in Silicon Valley. So I think I'm making a pitch to the urban economists to think more carefully and granularly about the source of these physical agglomeration benefits and to what extent they're upset by remote work.
Steve, you're spot on. Like, we have looked at this a little bit, and they're almost like CEO towns. they really love being next to other CEOs and kind of being almost neighbors to other CEOs. So we're thinking about a project of what happens when CEOs of an oil company and a tech company and maybe a utility all live in the same town, and kind of how that is correlated with corporate policies. But the first stage evidence is certainly there. They love agglomerating in these little tiny towns that you wouldn't, that are not necessarily even big metropolitan locations, just like Jackson Hole, Wyoming. Absolutely.
Very productive there. So it's a consumption.
Could be productive on other dimensions.
But I do think, to Steve's point about kind of the firm side of things, I mean, the other thing you can do is you can relocate the firm. And there's always this question, like, I don't think we know that much about how firms choose their locations. I think firms sort of organically sprout up from things and then they get to a certain size. But surely it is not optimal to locate a tech firm in Wichita. And so, like, when you have to go to Silicon Valley to search out talent to manage your tech firm, do you at that point start saying, like, do you see them change locations or at least open up you talked about the example of opening up sort of a satellite location, but the other way, given the value changes you're finding, I would just relocate the firm in some cases.
So to continue the Starbucks example, right? The Starbucks CEO was hired away from Chipotle. But what gets a little bit maybe less spotlight is that Chipotle had relocated their headquarters from Denver, Colorado to Newport Beach. Precisely to kind of accommodate the prior CEO. And we have a new project specifically that looks at headquarters relocations. It was striking to us how many of these headquarter relocations are really associated with what appears to be private benefits to the CEO. It's like where their kids live, or where their parents live, or where the CEO grew up, and so on. So this is an ongoing work in progress project. We have very strong first results showing that the private preferences of the CEO, so measured, are an important determinant of these locations. Now, with remote arrangements, when they get tired of remote arrangements, some of them, how do they end remote arrangements? They will acquire a company. Let's say they'll acquire a company in Newport Beach, and now, like, Seattle or Newport Beach, well, we have to choose one of the two headquarters, and then they'll choose the headquarters that where they want to be. So oftentimes they will either relocate the headquarters to kind of finish the arrangement, or they'll acquire a company headquartered in the area where they want to be, and they just move the headquarters to the target firm.
Great, thanks so much. Great. So we now have Megha Patnaik. She's going to be talking about management and remote work.
Okay, thank you to the organizers for having this paper on the program. This is joint work with Andrea Lamorgese and Andrea Linarello, who are at the Bank of Italy, and Fabiano Schiapardi, who's my colleague at the university. So this paper builds on a previous project we had where we were trying to understand resilience of firms and management practices. And what we found was that firms with better management essentially had more resilience, partly because they already had higher levels of remote work in 2019, as well as higher increases in remote work from 2019 to 2020. So expanding on that, we now have data for 2021, 2022, and 2023. And so we will be looking at, essentially in this project, the persistence of remote work for later years. So we've looked at the sway graphs a lot these last couple of days. So we know that there's increased remote work following COVID-19, in addition to the trend that was existing, and that these higher levels have persisted in later years in the new normal. What we have been talking about here is why there's heterogeneity across firms, and why some firms remain remote and some firms switch back or have different levels of hybrid work. And we can think that there are certain assets within the firm that can complement remote work, that can facilitate adoption, and that can also explain the persistence of remote work in these later years. Now, when we think about these assets, these could be physical assets. So there's work by Nick, Jose, and Steve on IT infrastructure within the firm, and whether these are provided by employees or provided by employers, or from employees, that these could help with the adoption of remote work. And then there's work by Filippo and Davide, which are on whether there's presence of broadband infrastructure that could help explain why there's heterogeneity geographically. There's less on what are the organizational assets within a firm that could explain these variations or these heterogeneities across firms. We talked a bit about how flat the organizational structure is in the conference. Where also, what I'm going to talk about today is going to be management practices. So what we have in mind is that remote work may be easier when the firm has mechanisms in place to help set goals, to measure outcomes, and to reward employees according to their performance rather than their tenure, for example. So in this paper, the question we're going to ask is whether management practices can explain the take-up, the intensity, and the persistence of remote work in firms. The data we use is going to be from the annual survey of the Bank of Italy. We're going to have management practices in 2019. We're going to have measures of remote work starting from 2019 retrospectively, and then 2020, 2021, 2022, and 23. We're going to have these for more than 1,000 medium and large firms. With this, we're going to be estimating the extensive and intensive margin relationships between management and remote work in the new normal. Now, when we think about the intensive margin, we essentially have a selection issue, which is that we don't see the intensive margin for firms that don't take up remote work. So to adjust for that, we're going to use a Heckman framework to correctly estimate the intensive margin relationship. For that, we're going to use an instrument which is going to be local COVID-19 restrictions in late 2020, and we'll see how that works in a bit. So what do we find? We find that both on the extensive and the intensive margin, better managed firms are going to have higher levels of remote work. On the extensive margin, we can quantify both of these. So on the extensive margin, if we have a standard deviation increase in the management score, this is associated with a 6.1 percentage point increase in the probability of remote work at the firm. On the intensive margin, one standard deviation increase in the management score is associated with 2.9 percentage point increase in the average share of employees working remotely on a given day for firms that have remote work. So today I'm just talking about this relationship, but what we want to do moving forward is essentially look at which particular management practices matter. So we're thinking particularly about monitoring, and we're thinking about incentives. And also we want to talk about firm performance very soon. So we want to see whether when you have this complementarity, how does it translate into firm performance? Okay, so the data set we use is the annual firm survey of the Bank of Italy. So from that, essentially it has rich data on firm balance sheet variables, on costs and so on. So you can imagine this is very close to like a census survey in its questions, or closer to the ASM if you've worked with that. Now this could be so in this questionnaire, we also introduced a management module in 2019. So we had a set of 8 questions on management, which was essentially based on the survey we did with the US Census. And that captures management sort of in a standardized measure, depending on what practices are present in the firm. Along with this, we also have a consistent measure of remote work based on additional questions. So the survey basically introduces a few questions every year. And so we're going to have the same question on remote work across different years. So the sample size for our survey was 3,000 firms with remote work, but we had the management module only for about 1,800. So at the end, when we get a balanced panel, it comes to about 1,000 firms. And we're going to be able to use the other questions in the survey to control for drivers of remote work. So we have size, we have skill, we have the presence of IT in the firm to some extent. And then we're also going to be able to look at performance outcomes, sales growth, productivity, and so on. So for those of you who are not familiar with the management questions, these are essentially questions which are trying to capture the presence of certain practices within the organization. So we're not looking at managers, we're looking at the practices themselves. These are along 3 different dimensions, so monitoring, targets, and incentives. And monitoring can be something like how many KPIs do you track? Targets can be, do you set short-term targets or long-term targets? How often do you review them? Who knows about them? And incentives can be, do you promote people based on promote, hire, and fire people based on tenure or based on performance? These are derived, like I said, from the US MOP survey, which is where we try to create a closed-ended version of the World Management Survey, if you're familiar with that. And originally, these are derived from lean manufacturing principles in Toyota. So here's an example of a question. So the question is, when your firm encountered a problem in the production process, what happened? And the options are that it was solved, but no further measures were taken. It was solved and further measures were taken to prevent it from happening again. It was solved, further measures were taken to prevent it from happening again. A continuous improvement process was launched to prevent such problems from occurring in the future. No measure was taken, and then because the survey is run in Italy, there's an option which is no such problem ever occurred during production, which we added in cognitive testing. So when firms answer these questions, so they answer 8 of these questions, and then we score every single one of them, and then we're going to aggregate it up. So the worst option, we could say, that no measures were taken, would be assigned 0, and the one which says option 3 would be assigned 1, and then all the other options in between would just be given a 1/4, a 1/2, and 3/4. So all of these questions are scored, and then there's an average taken, and then the score is normalized, and this is basically the management measure. On the remote work question, essentially, the identically worded question was asked for 2020 and then 2019 retrospectively, and now we have the same question for the next few years. So the question is, what's the average share of staff working remotely on a given day? And we actually use total staff, so we have 2020 and 2019 retrospectively, but it would be helpful also if you have any suggestions on how we could use the second part of the question, which was only asked in the first year, on considering only top and middle management and white-collar workers. So the nice thing is that we have the same question for all the different years. The not so nice thing is that the question's asked in such a way that you don't really know the composition. So you could have a firm which either has a few employees working fully remotely, or you could have all your employees working slightly remotely and you can't tell which is which from here. And that makes it difficult to line up these numbers with the labor force survey, but broadly these are in line. Okay, so first I just want to show you the work from home trends in Italy. So Italy did not have a lot of remote work starting out. So this is the average of the answer to the previous to the question on the previous slide. And so here you can see that from 2019 to 2020, remote work went up, according to this measure, from 1% to 14%. And then, of course, slowly it flattened out. Now, Italy, just like the rest of Europe, has lower levels for every single year of remote work compared to the US. And then within Europe, Italy had the same increase as, say, France or Germany, but then it had a much stronger reversal, okay, which would be something that we want to think about. And when we break this down into the extensive and the intensive margin, we find that most of what's happening is on the extensive margin. And you can see, like, from 2019 to about 2022, there's a 3-fold increase on the extensive margin in firms that are working remotely, whereas there's less movement on the intensive margin. So we're interested in management, so what we're going to do next is we're going to split this just very simply into low and high management. And what we can see is that for every single year, if we look at the firms with the high management score, which are the red bars, versus the low management score, which are the blue bars, every single year the firms with higher management are having higher levels of remote work. Now, we knew that that the differences were coming mostly from the extensive margin, and we actually see that also when we split by low and high MOPS. So if we look at the extensive margin and low versus high MOPS here, we can see that for every single year, the high MOPS firms have higher levels of the extensive margin, as well as on the intensive margin. However, the differences here as well come mostly from the extensive margin. So obviously in the previous slide, we just had a split of the sample and we didn't have any control, so we want to run a regression. So what we want to do for the extensive margin is we want to have essentially the outcome to be work from home in 2022. We could take 2023, but essentially we'll lose a few observations. There's not that much difference in the levels as we saw over here. So essentially, I'm just going to take 2022 here. And then we want to regress this on the management score, which was measured pre-pandemic in 2019, and any other controls that could drive the extensive margin of remote work measured in 2019. So these would be log employment, whether the firm had any advanced technologies such as cloud computing or the presence of AI, the skill, the average level of skill, which we measure as the share of white-collar workers in the latest year available before 2019. And then we're also, which is very nice about this particular data set, is that we're able to control for remote work in 2019. Finally, we don't have occupation level data, even if we are able to match to employer-employee data, which we can do. So we need to somehow control for the fact that across firms you have different opportunities for adopting remote work. For that, right now, we just have the macro fixed effects. So these are very broad sectors, but if you have any suggestions, that would be helpful. So what do we find? Essentially, if we just look at the simple correlation between management and the extensive margin, we find that it's positive significant. What this translates into, because it's a normalized management score, it means that a 1 standard deviation increase in the management score would be associated with 14 percentage point increase in the probability that you adopt remote work. So the first control, we start adding controls. So the first control we put is employment. What we have in mind is that firms can either cover some of the fixed costs of shifting to remote work, but it might also be that because there's so many employees, it's more likely that some of them would be working remotely. When we do that, there's a slight decrease in the coefficient, but it continues to be significant. Then we want to add controls for other things that might explain the extensive margin of take-up. So we add whether the firm had any advanced technologies in place. These are not the ideal advanced technologies that you want to think about, but these are the ones that are kind of measured in the survey because AI and cloud computing are the hot words. Then we also control for the skill to whatever extent we can by bringing in employer-employee data. And we find that, again, the coefficients remain similar and significant. Finally, we control for the level of remote work in 2019 that was already there in the firm. And after that, we also control for these sector fixed effects, like I said, to try and understand how much of it could be driven by what kind of firm it was. So if we try to do the same regression for the intensive margin, it just doesn't work because your coefficients are going to be biased. Your OLS is going to be biased because you don't measure the intensive margin for firms who haven't entered. So you're going to find that it's not significant if you just run a simple OLS because this is wrong. So what we try to do instead is we try to do a Heckman correction for this selection problem. So we want to estimate the intensive margin. And for that, we need to essentially have one step before, which is the selection equation, where we look at where we look at the work from home on management, but we include an instrument. Our instrument is going to be the stringency index. This is an index of COVID-19 restrictions at the province level in Italy. And it's very closely related to the Oxford tracker, but it's going to diverge as soon as the vaccine comes in and people have green passes, because then the stringency changes. So in the first stage, we're going to have the extensive margin with management and the stringency, along with controls from 2019 that we had before. So exactly the same specification. And then for the intensive margin, what we're going to do is this is going to be the second stage of the Heckman. And then we're going to have the intensive margin with management, with the controls, and then we're going to have the inverse Mills ratio, which is the correction term, to be able to effectively get the alpha 1 correctly estimated. So this is just a map of the stringency index. This is from Conteduca and Borin, published in 2022, which is the one we use. And as you can see, this is a normalized index here that we're going to use for 2020. And this is going to vary a lot across the provinces. As you can see, there's some areas where there's higher stringency in 2020 versus others. So the assumption that we're making here, the assumption for this to be a valid instrument, is that the stringency is going to affect the take-up of remote work on the extensive margin, but it's not going to matter for the intensive margin. So when we estimate the intensive margin, the first column just replicates the OLS with all the controls that we had in the previous slide, and everything's insignificant. Management is insignificant. And then when we look at the Heckman, the first stage, which is the third column here, we can also already see that the stringency is significant, which means essentially it's a valid instrument. And then in the second stage, what we do is we take the firms who had remote work already. So the sample is the ones who have positive remote work. And then we run the regression with the correction term, which is the inverse Mills ratio here. And that's significant, basically saying that selection is a problem. And when we do that, we see that now the management coefficient is significant over here. This coefficient would mean that a 1 standard deviation increase in the management scores associated with a 3 percentage point increase in the in the intensive margin, which is the share of employees working remotely on any given day. So far, we've just basically established this relationship, but we haven't really looked at any outcomes. So the next things we want to do is we want to look at performance outcomes, including productivity growth, sales growth, and whether firms are able to have lower costs in terms of different cost components. So we have all of these in the survey, so these are available for us to measure. And one of the channels that we've talked about a bit is, can we get a wider share of wider pool of people to hire from, maybe get a better quality of workforce in the firm, or just have better matches, which could be the channels through which productivity goes up, for example. And of course, pay structures are going to be different once you go remote. We're also very interested in looking at which particular component of management matters. So we expect that monitoring is going to matter, because essentially, are you looking at output coming out of the firm? Are you tracking that? And incentives, whether you're paying people based on their performance rather than their inputs, for example. So to conclude, basically in this paper, we look at the relationship between management practices and remote work for a panel of more than 1,000 Italian firms. And overall, I've shown you the trend that what remote work looked like over the years, and the fact that it varied by management. And also the fact that there's significant extensive margin as well as intensive margin effects. And like I said, the next steps would be looking at firm performance outcomes and looking at different components of the management score. Thank you.
Thanks for that. Can you just restate for me the identifying assumption that underpins the estimated
Heckman?
causal effect of management scores on the intensive margin, which I understand, correct me if I'm wrong, to be the overall level of work from home activity at the firm, the 3 percentage point number.
Yeah,
But
so
I wanted to make sure I understood the identify assumption.
So in the sense, it's not identification as we would think of it. It's the Heckman correction.
Right, but, okay. But
Yes, that's fine. So essentially, we're saying that what we need is we need an exclusion restriction which says that the stringency affects the take-up of remote work in 2022, which we think happens because it drives the take-up of remote work in 2020, which is when the stringency is, and that predicts 2022 take-up. But this should not matter for the intensity.
Okay, but the
Yes.
take-up rate here is the firm-wide take-up rate?
Yes,
So on
exactly.
the extensive margin, so any work from home.
Exactly. So if you look at the question, essentially it is, if this is non-zero, then that's the extensive
Okay.
margin.
But I guess what I'm struggling with is why wouldn't you expect the stringency to also have a direct causal effect on the intensive margin, even conditional on take-up at a firm, because it encourages more people to experiment and so on?
Yeah, so what we were thinking about is that even if you were a firm, for example, in an essential sector, you would still maybe have some of your staff work remotely just because it was COVID.
I get there's an orthogonality assumption here underlying your selection correction, and I guess I'm not quite sure why I should buy that orthogonality assumption, because maybe I'm missing something, but it seems to me like the stringency of the regulations that prevailed in 2020 would affect the extent of experimentation on the intensive margin within the firm, and that in turn would have a direct effect on how much activity there is on the intensive margin later on when these restrictions are removed.
Yeah. We were thinking it matters more according to the firm characteristics or the composition of the firm or what the firm does for the intensive margin more.
It's not that I have a constructive solution to the identification challenge, so I don't have a better alternative to offer, but it's not entirely convincing if I'm understanding it correctly.
Yeah, we need a story. We've been working on it.
A related comment, I was wondering if you needed the intensive versus extensive. Like, could you do just extensive and then just
could.
total work from home days in the firm, and then you don't have a selection issue? Like, just do the percent and have the zeros in there.
Yeah, so
But
just
then-
the average, basically.
Yeah, just
yeah,
the
we
average.
could do that. We
I
could
feel
do
like
that.
that would have been informative for me.
We could do that. It was just that a lot of the activity was happening from the average. Like when you look at the average, which is the blue, versus if you look at the red, you get a lot more variation in the red.
Yeah, that's fair.
Great, thanks. The thing that would be cool to see is the performance stuff. Just to
Yes,
restate, I think
yes.
the idea is when folks are in the office, you can use kind of management by walking around. You can basically watch what they're doing, which isn't great, but you can put up with it. But when they're working from home, you can't do that.
Yeah.
So you need much better management practices, in which case you'd expect to see it like profit rates, survival rates, growth rates. I would have thought particularly in 2020, because in 2020 you're fully remote. So I
Yes.
assume if you're badly managed in 2020, it's really painful. I mean, it's oddly enough, as somebody I think mentioned, am I getting confused between events? Marissa Mayer. Anyway,
Yes.
when did that come up? Was that?
Yesterday.
So I spoke to, I think Mark, you mentioned it, didn't you? So I spoke to Marissa Mayer like a year and a half ago and asked her what happened in Yahoo in 2013. It was kind of this story. Because she said, when I was the CEO, they had terrible performance management systems. We had this bunch of fully remote people and had no idea what they were doing. And no one seemed to have any idea what they were doing. And so I called them back in the office and put in performance management, and they let them go out to hybrid. But I think the really useful thing would be all the performance stuff, because it's a strong complement to.
So we have good variables for performance. So anything you can do, for example, in the census, you could do here. We found that 2020 is difficult because essentially everyone went remote, and Italy had essentially there was a pay support from the government. So there was this decision of whether you would take the money and have people work or just shut down essentially. And in our sample, we don't have so many exits because these are sort of the larger firms, because the survey is trying to track output and employment. So output, like separately from GDP estimates. So,
At least over the long run.
yeah, so we could do performance estimates, maybe not exits, but we could do other variables for 2020. Thank you. Yes.
Yeah, so this is not a fully formed thought, but just trying to think about how you could sharpen the identification. And I was wondering if you could exploit variation in the firm location in two ways. So you mentioned the variation in remote work how sustained the effects were across European countries. Mm-hmm. And I was wondering if you could look at border towns versus more interior regions of Italy. And the other thought I had was, even within Italy, like the south of Italy had some incentives to promote remote work. So there was a policy called Southern Working.
Yeah.
And I wonder, so that may not be completely exogenous to firm location ex ante,
Exactly.
but there might be some, some wrinkles in policy at the regional level or the border region that might give you some more legs on identification.
Yeah. No, this is true. So in the last project we had, we did look at North versus South. And the problem is that in the South, the firms are less productive on levels. And essentially, that difference is already there. And the policy is endogenous to that fact. So that was one problem. And actually, in terms of identification, the sort of biggest problem I have right now is that even if we believe this instrument for work from home, we still need another one for management, actually, because for the interaction. So if I want to look at what the interaction does, then I need another exogenous variation.
A very interesting paper. I'm wondering whether any of your firm are actually multinational firms. If so, you could actually use other countries' lockdowns at different times as potential exogenous variation.
Yeah, that's very interesting. Also because so this is annual data, so that's a bit difficult because we don't have high frequency. And essentially the lockdowns broadly were 2020 but Italy did have like 3 different lockdowns. Actually, the lockdowns were also moving together, and in fact, firms adjusted a lot of their internal decisions when the Italian lockdown was announced. So, for example, German firms adopted different practices when Italy went into lockdown. So you can see that basically they updated their expectations, they changed their suppliers and so on as well.
Thanks so much.
Thank you.
Okay, so now for our last one, we're going to have Raj Chowdhury talking about CEO bots.
So thanks for sticking till the end. And, I've learned so much over the last 3 days. And I just want to extend my thanks to my co-organizers, especially Nick and Steve, and the team at Hoover. It's been a wonderful conference. So thank you so much. So I'm going to be really ambitious, and I'll try to present results from 2 papers, both working papers. I'm going to skip all literature review. I'm going to cut the motivation and just go into the results straight away. And these are both very early stage papers, so would love to get your feedback now or offline. But both of these papers are focused on this theme of hybrid and remote work and within firm communication. So why study within firm communication? I'll just motivate it very quickly. This is part of the message the memo that Andy Jassy put out during the 5-day return. And the argument, if you read it, is that face-to-face is a better technology. It helps us coordinate better, it helps us learn better. So period, face-to-face is better communication technology. So that's one argument. But on the other side, there are also all these anecdotal, so Mark showed a bunch, I'll show one, anecdotal reporting that it's not about face-to-face communication for coordination, it's about monitoring. That the bosses really want you to show up because they are fearful of shirking, and so they just want to monitor your presence, and they're not only monitoring how many days you show up, but how long you're staying, and all of that. So there are these two competing sort of narratives about coordination, face-to-face being a better communication and coordination technology, and monitoring. And so in the first paper, we're going to try to estimate some effects in a hybrid workplace. So this paper is joint work with Christos Makridis, Kyle Sherman, who's a doctoral student at HBS, and Miguel Espinoza, who's at Bocconi. And so this builds on the experiment that we ran in 2020, and we already have a paper out of that looking at employee surveys of their stated job satisfaction before and after. But this paper goes into the communication aspect of that experiment. So here's the experiment in sum. It's an experiment with 123 HR employees. It ran for 9 weeks. And we randomly assigned these employees to either work from home or work from the office every day. So there was a randomization at the daily level. And what we're exploiting in this paper is that because of the randomization, the patterns of co-location are also random. So whether me and Jose show up in the office together on the same day is also random. So we're going to exploit the variation at the dyadic level. What's the data we're exploiting? We have the entire reporting structure of this firm for this HR division. So we're going to track both horizontal communication between workers, but also vertical communication between workers and managers. And then we have the text of all the emails they sent during the experimental period and a prior period. And so using the text, we essentially employ machine learning techniques to classify the text as either coordination emails or monitoring emails. And we have other classifications too. We have personal emails and we have learning emails. I'm going to show you the results for coordination and monitoring. And how did we do the machine learning classification? At a very high level, we randomly selected 1,000 emails. We had human coders classify them as coordination or monitoring or helping or personal. And then we use a word-to-vec model, a doc-to-vec model, and then a k nearest neighbors matching technique to take that classification to the entire corpus of 32,000 emails. So what do we find? There are two main findings. If you look at the worker-to-worker communication, the horizontal communication, what we find is that when workers are not co-located, then they send fewer emails to each other, they send longer emails, and they're more likely to send coordination emails. So when they are working not face-to-face, they are using electronic communication, and they're mostly using it for coordination purposes. But then something interesting happens when you look at the worker-to-manager emails. There we find that the workers tend to send more emails when they are co-located with their manager in the office, and they're more likely to respond to monitoring emails. So the workers, I think if you put these two together, the way we interpret the results is the workers have figured out how to communicate with their peers and their managers differently. So with their peers, they are communicating more coordination emails when not co-located, and with the managers, they're responding to monitoring concerns when co-located. So these are some of the examples of the coordination emails. I'll put it up for a minute, but we're going to put this out in the paper. The monitoring emails are actually responding to the manager's monitoring. So this is a classic example on the top. It's already done, please check and confirm, thank you, right? And I'm sure we have all responded to these emails from our supervisors and managers. So on the count of emails, we actually don't find, the main effects are imprecise. On the worker-to-worker, we find a weak negative effect on the count of emails, and then we don't find any precise estimates for the worker-to-manager emails. But then we find interesting patterns when we look at the length of the emails. So these are the worker-to-worker communication. So the top left panel is showing that workers, and this is consistent across, so the baseline, the omitted category is co-located in the office. And we find that compared to being co-located in the office, workers are sending more emails when not co-located under all three conditions: when they're both working from home, when the sender is working from home, when the receiver is working from home. And here we control for a bunch of fixed effects around the sender, the receiver, the date, and then we are clustering the standard errors in this specification at the sender level, but it's robust to standard errors clustered at both the sender, receiver, dyad level. And then the interesting parallel result is what kinds of emails they're sending. And here we find
the probability of sending a coordination email is higher when they are not co-located. And that's also consistent across the three conditions, when they're both working from home, when only the sender is working from home, when the receiver is working from home, compared to when they're both co-located in the office. And then these are the worker-manager communication. And here we find the flipped result, that the workers are more likely to send fewer emails when not co-located. And so they're across all the three conditions, when they're both remote, when the sender is working from home or the receiver is working from home, they send shorter messages, compared to when they're both the manager and the worker are co-located in the office. And then we didn't find an effect on the coordination emails for the worker manager. As you can see, everything is imprecise, but we find that the worker manager on the monitoring, they're more likely to be monitoring emails when the manager and the worker are both working from the office. So that's so far we've gotten this paper, and I would love to get your thoughts either at the end of the talk or offline on what else we should be looking at and how to take this paper forward. Now, this is the paper that was listed in the agenda, and this is about organizational communication in an all-remote firm. And so I think we've already seen some examples of this come up in the conference, and I think especially the paper on startups mentioned this. There are now a whole class of startups which do not have any offices. So, in the last version of the conference, I had a paper where I presented results from an offsite, a retreat, and whether that retreat as treatment effect had any effect on organizational communication after the retreat. So it's the same firm we study. It's a firm called SIEPR. They have about 800 employees. But once again, I want to mention that there are hundreds, if not thousands, of such all-remote startups. And I've worked actually with 3 of them, with Doist, Zapier, and GitLab now. So this particular paper, so if you think about the context of an all-remote firm, a firm that does not have any offices, one of the questions is, how does the CEO communicate with the workers? Because there is no town hall. There is no place where the CEO can get together with the workers and communicate. And so one of the options that, when I was trying to plan for this research, we brainstormed is whether they could use generative AI to communicate with employees. So the question in this paper is, can generative AI, can a CEO bot effectively automate CEO communication? And so we have 2 specific sub-questions for this. The first one is, do the employees believe communication coming from a bot as authentic? Can they distinguish between the human CEO and the bot CEO? And the second question we have is, do employees find the bot communication equally helpful as the human communication? And this is a first-order question for these all-remote companies, because maybe if this works for the CEO, then they can all have bots, and the bots can communicate with each other when they're sleeping or when the time zones are too distant. And a part of the organizational communication, so bots can become a complement to the human if this works out. So if this works out, this can have profound implications on how these all-remote companies could work and communicate, and that could further make them more distributed, and the geographic boundaries could spread out even more. So what we did in this study is, first we created the CEO bot, and I'm going to spend a little time on the technical details here in a minute, but it's a challenging proposition. So creating bots, turns out, is not an easy thing. We took 6 months to develop it, because you have to imitate both the content of what the person would say, but also the communication style. So each one of us writes English in a different way. So Steve writes his emails in a certain way, which is different from how Emma would write it. We all have our pet phrases. So you have to imitate both the content of the communication and the style. So I'm going to come to how we did that. In the second step, we crowdsourced questions that Zapier employees would like to ask their CEO. And we actually let an LLM select the 10 most popular questions. And then in a field experiment, we took 105 employees, and this is a within subjects experiment, and we randomly selected them responses either from the human CEO or the bot CEO. And the employees were asked to guess the source of the communication. Is it a human? Is it a bot? And were asked to rate how helpful the response was. So on the first part, this is essentially what we're calling a Wade test, named after the CEO that we are imitating in this case, Wade Foster. So Wade test is a variant of the classic Turing test, because the Turing test is you're asking whether it's a machine or human. But this is asking whether it's a machine or a specific human, in this case, Wade Foster. And so in the experiment, they get to see either the response from the human CEO or the bot CEO. And as I said, the employees are rating the helpfulness, but first trying to guess whether this response is coming from the human or the bot. So these are the 10 questions. I know you can't read it, so I'm just highlight 2 of them. Some of the questions related to the company's future plans, so or your past plans. So can you share an example of a particularly innovative or impactful way the customers utilized? We use the pseudonym, but the company has allowed us to use their name, so I'm going to say Zapier, to transform their business. And then some questions were personal or organizational culture. So how do we foster continuous learning and development? The kind of questions you would expect employees to ask their CEO. And so as I said, the communication, we have to imitate both the content and the style. The way we did that is to construct a rephraser algorithm. So I'll spend a minute on what this is. So what we did is, in the first step, we took everything that Wade Foster had written ever. So all emails, all Slack messages, all company documents, even the stuff he would write for himself. And then we took all of that English, and we fed it into 5 LLMs and said, how would you write the same passage as a normal manager working in the US? So it's not playing around with the content, it's just playing around with the style. And so that is the phraser. So, and then what we did is we took the 10 questions, we trained 5 large language models to answer. So we fed those LLMs with all kinds of company documents, like whatever they had, the strategy plans, the annual business reports. And then we had the LLMs answer those questions based on that training data. But then that just gives you a generic answer. And then we flipped the phraser algorithm on its head to say, how would you answer this generic LLM answer in the words of Wade Foster? So that's the rephraser. So it has 2 steps. One, to get the content from the LLM in a generic way by training it with company data, but then to rephrase it in a way that Wade Foster would have answered. And I think this is a methodological innovation of this paper. To the best of our knowledge, we are the first to use this rephraser algorithm. So these are some of the responses. I'll let you, I know the font is very small. Some of the bot answers are really, really thoughtful. So I think, okay, so let me go to the results. So this is the confusion matrix. So we have a actual origin, the AI or the CEO, the perceived origin, the AI or the CEO. I'm just curious what people think. Like, do you think the bot passed the Turing test in this case? So it passed by flying colors. So the employees were only able to guess the source correctly 59% of the time. And that's just better than random chance, right? Just better than flipping a coin. And this is the confusion matrix. So if the actual origin was AI, the origin was perceived as AI 26.7. And so this diagonal is the correct answer, and the other diagonal, the cross diagonal, is like the wrong answer. And so these are question by question the accuracy of the employees' answers. And actually, for 6 out of the 10 questions, the accuracy is less than 50%. So I think in sum, at least this result shows that LLMs and generative AI are technologically now capable of replicating human answers. Now, here comes the really interesting part of the paper, in my view. Then we look at the perceived helpfulness. And so what we find, I know you can't read the tables, I'm just going to, what we find is that the perceived helpfulness was negatively correlated to perceived AI. Now, the employees might have perceived AI incorrectly, But if they perceive the source to be AI, they give it a lower rating on helpfulness. Now, this is not a causal result. So we did the best we could. We ran a Barron and Keeney mediation analysis with bootstrapping. And we find that the entire effect, so the effect is true AI is correlated to perceived AI is correlated to perceived helpfulness. And we find all of the mediation analysis, the effect is the indirect effect. But because there's a reverse causality possibility here, that the perceived helpfulness might have made the person rate it as a perceived AI, then we took this result to the lab, and we ran a lab experiment. So in the lab, what we went to Prolific. We took about 218 individuals who had similar profiles to the folks in our experiment. And here we are engaging in deception. So we have a 2x2 matrix. We took 3 companies. We took what the CEO had written in the latest annual report, and then we had that answer, the question answered by 5 LLMs again, and then we took the mean answer. But then we are essentially engaging in deception, where in some cases we are labeling the CEO answer as an AI answer, the AI answer as a CEO answer, and also the diagonal, the CEO answer is a CEO answer, and the AI answer is an AI answer. And we conducted a similar within subjects experiment and asked them to rate the answer based on helpfulness and the share purchase intent. And so this is one of the questions that was asked to the Amazon CEO. And so we took the CEO's answer, and this is the AI answer. One thing I should quickly show, I think I forgot to show this, was, I think I lost that slide. So there's some interesting differences in the tone of the CEO's answer and the AI answer. And what we found is that the AI, so we took, from the communication theory literature, we took 5 dimensions: excitability, sternness. We found that the AI typically has more excitable answers, and the human CEO typically has more stern answers. But then the lab experiment, we got very strong evidence that perceived helpfulness is negatively correlated to perceived AI. So I think, and this is actually in a long tradition in the organizations and IS literature, where they have theorized about what they call algorithmic aversion, that humans, especially experts, are very averse to algorithmic responses. So in summary, I have like 5 minutes left, so I'm just going to summarize, and then would love to get your thoughts and questions. In the hybrid workplace study, we find that, at least based on this one study, that employees seem to be engaging in heterogeneous behavior for their communication when they communicate with their peers and when they communicate with their managers. So with their peers, they tend to do more coordination emails when working from home. And with their managers, they tend to respond to more monitoring emails when in office with the manager, co-located with the manager. And in this all-remote workplace, we find evidence that suggests that today's capabilities of generative AI, generative AI can pass the weight test, but the big challenge really here is how do we mitigate the algorithmic aversion? And I think that has implications beyond this study. So all the AI technologies that are being developed, how do we make humans like what the AI technologies or the Gen AI technologies are capable of doing? So I'll stop there and look forward. Thank you so much again.
2 things. One is, does it matter who's assessing it? You maybe only had 50 people. I'm wondering whether folks that know him versus folks that don't. And the other thought is, it's kind of hard to tell on a response. It may be the AI responses are completely useless. They sound like, they're totally disconnected. I mean, I know you're not looking at it, but it may be they're totally disconnected to other things in the strategy. As far as I know, in the AI, they kind of a very short-run forecasting. So the few sentences seem coherent, but they may not be coherent in a bigger picture.
Yeah, so great questions both. So on the first one, we found, so we actually have 105 employees in the experiment, and each one of them are responding to, seeing 10 questions. So the sample size is about 1,000. So we find the more experienced employees guess more correctly. And so that's the first. And the second is to take care of the tails. What we did for the AI, so first of all these 5 LLMs were trained with company documents so that they were able to give answers that would be more authentic. but then we took the average answer across the 5 LLMs. So we took like Claude, Claude and ChatGPT, and we took like 3 others, and we took the average answers to sort of like mitigate the hallucination, the extreme tails possibility.
So really imaginative research. One comment and a question. Comment, I would think the effectiveness of this, how well this would work in practice, would vary greatly across companies with the quality of the content that you can feed into the content training part. And it highlights for me what I think is we already know to be true of all remote companies. Things need to be written down and codified in a clear manner to facilitate asynchronous communication. Right. And if we're going to then generate bot-driven responses from that, it's even more vital that the content be accurate. So you might get very different results across when taking the exact same methods and rolling them out for different companies. Right. The second thing you focused on, which you just mentioned in your response to Nick, you took the average response across 5 different LLMs. Yeah. But it would also be interesting to differentiate between questions where all of the LLMs gave pretty much the same response and questions to which they gave wide variation response. The first case suggesting, well, the content that you're using to train that the LLMs are drawing upon to answer that question is really crystal clear. Doesn't admit much ambiguity in the answer. And try to exploit whether. Then we go to your perception stuff. I don't know whether you can speak to this, but when people they regard it as less helpful if it's an algorithmically generated. Is that because they just don't like thinking that I didn't get the time and attention of a human, or because they draw the inference that if an algorithm gave me the answer, it might not be right?
Right. So all great thoughts. So quickly on the documentation point, I completely agree, and it'll be fun to run like a similar study across multiple firms with different levels of documentation. I would love to go back and do tease the variation on the LLM answers being more homogeneous versus heterogeneous. That's something we can absolutely do. And on the last point, I think it's a great question, Steve, and I think we need more research, both in the field and the lab, trying to tease out the antecedents of algorithmic aversion. So far, I think the documented literature is experts tend to exhibit more algorithmic aversion, and that also might be because of employment loss fears. So there are lots of mechanisms that need to be and I totally agree we need more research on that.
On Steve's point, there is a genuine downside of the AI that it only can reply based on what's in the public domain. Yeah. So it's kind of, I'm asked the CEO a question. There seems to be 2 very different types of questions. One is like GitHub, you ask the question that's in the manual, in which case AI may be better because AI can immediately pull out the manual. And then there's another type of question that's asked, what are you thinking of doing in future, in which AI may be completely useless because if it's not written down, it just kind of makes stuff up. And so they seem like extremely different. And in some cases, it's like a summarization tool and it's great. And in others, it's a predict the future, in which case it's potentially completely wrong.
Right, totally. And for that reason, in this experiment, we took all the documentation, and Wade also gave us his private diary, like what he was jotting down as thoughts between meetings. So, we got but in every case, you may not get that documentation.
That was part of the training set.
Yes. Yeah, and the one thing I would say, going back to thinking about human capital, the reason, I think this is interesting is, if this works and if people start liking the content, this allows us to scale human capital in a way like never before. Because then the CEO could potentially participate in some future date, in 3 meetings in parallel, right? And even be participating in meetings while flying on a plane, and the bot can, make some responses in a meeting. So I think there's a lot of interesting stuff that can happen, but we need to get the technology right.
Or with his surfboard.
Yeah. Yes, Mark.
It's a very interesting study. This is definitely consistent with algorithm aversion. I'm thinking whether it's also related to outcome effect, because if I ask the manager a question, manager give me suggestions, I just follow the suggestion. If things do not work well in the end, manager cannot blame me for following his suggestions. But if it's AI's recommendation and things do not well, the manager could still say, you should make your own judgment. Couldn't you tell AI just give a bad recommendation? And then they may find AI's suggestion less helpful and more skeptical of AI's suggestion.
Sure. No, I think that's it.
When you did the deceptive experiment, I imagine that if the algorithm were really bad, people might actually be able to even figure out that you were lying. Do you feel like everything that you gave them was kind of sufficiently plausible as a human answer that they wouldn't have done that? The thing I'm really interested in is if I find the answer helpful, then I'm going to assume that it came from a human, and if I find it really super unhelpful, then I'm going to assume that it came from a bot. And even if you tell me, I might start wondering whether you were lying about what you told me. So what do you think about that?
So in the second experiment, we don't have that concern because we are randomly assigning the labels. So whatever the answer is from the human and the bot, we are randomly assigning. So on the 2x2, we are randomly assigning the labels. So some of the AI answers were labeled as AI, some of the AI answers were labeled as human, and some of the human answers were labeled as AI, and some of the human answers were labeled as human, and that was done randomly. So we're less concerned about, but that's precisely why we had to run this experiment, because in the in the field experiment, there's that possibility of reverse causality, that if the answer looks less helpful, then I rate it as coming from the AI, and that's why we had to go to the lab.
Yeah, I just wondered if it could work.
I have to think more about that, so maybe let's chat offline, but we're also averaging out against the 5 LLM answers to take away the extreme answers that sound like completely implausible. Yes.
So I'm new to this topic, so take these thoughts with a pinch of salt, but I've noticed that my dean has definitely been using AI to respond to me. And on the one hand, I feel I'm a little bit disappointed in him. On the other hand, it's nice just to get a response. And so I'm just wondering, in this experiment, to what extent there's the kind of that good feeling that you get just from being responded to, that maybe the CEO, and how you can kind of tease out whether the CEO would have responded if there weren't the AI there, if that makes sense.
Yes, our treatment is not like response or no response. All of these 105 employees go through a Google Sheet and they're going through a response. The only thing they don't know is whether the response came from the human or but I think it's a great question, and we could run a new experiment with no response versus some response, and conditional on a response, it could be from the AI or the human, and I think it's an interesting idea that.
I was wondering about information leakage of the AI. I know you have the 2 steps, but some colleagues were trying to see whether once you fit the information set of the LLMs, whether they actually stick to that information set that you tell them to, but they find that that doesn't work. I mean, they still kind of, suppose that you want to predict 2011 GDP growth, and you say, oh, okay, no, you only know up to 2010. Somehow they see between 2010 and 2011, even if you try to do your type of 2 steps, or to try to kind of insulate it. So just wondering how can they affect the results. It could be related to what Steve was saying, to look at the homogeneity of the answers rather than to the heterogeneity. There could be some information leakage when you find the answer more heterogeneous.
So I'll have to understand the concern better. So for this experiment, the field experiment, the contamination was avoided by having everyone go through this experiment at the same time. So the 105 people had to all, there was a time window, and they didn't know who else was on the experiment. So the subjects, there was, we don't think there was a lot of contamination, but maybe you're asking a.
Yeah, not for the people. For the LLMs, the way they generated the answers.
Okay.
So that's what might influence the way people are actually classifying it, because you're supposed to write as Wade, but then there could be information leakage because you're asking the LLMs to write general answers first, and there could be like a style of somebody else leaking in the way Wade was supposed to write. So I don't know if that would.
Let me talk to you offline. Yeah.
Thanks so much.
Thank you so much. Thanks a lot.
So thanks very much, everyone that stayed through 2 days of work from home papers. We should thank Farin and Sherry, who have kindly organized everything, Ben, who's sitting over here. It's been fantastic. Thanks so much for the super organized. I think this is like about the most organized conference I've been at Stanford, so thank you very much. Including the cookies with like the Stanford logos on it yesterday. And I think we have lunch outside now, is that right? Great. And next year we'll be choosing all the papers by LLMs. I think we'll like feed in the last 3 years of papers and say like, what's the...